Hi. Investors' concerns about banks' real estate exposures have flared up across the planet. And we have discussed here names like New York Community Bank Corp and even the Japanese Ozora. But the reality is that the scrutiny is global and might even reach the safer lands of South Korea. So it's a good thing that we have Rena Kwok with us today. Rena, you cover South Korean banks from a credit perspective. So could you please characterize the sector for us from a real estate exposure, capital levels, and asset quality perspective, please?
Sure, thanks for having me, Renato. Now, let me just summarize the real estate risk we see for the South Korean banking sector, both locally and abroad. Now, in terms of the local property exposures, we think that the risk from property financing are manageable, and this is due to a couple of reasons. Firstly, the big four financial groups have actually improved their loan loss buffers. They have tightened the underwriting as well as their modest exposures could help them to limit the outsized credit stress from their exposures amid this sluggish real estate outlook that we have this year in the South Korean economy. Now, in terms of lending, a lot of their exposures locally are to good quality residential properties, residential projects with government guarantees. So this helps to actually limit severe stress to their risk profile if there is a severe property downturn. Now, in terms of overseas exposures, what the investors are, keenly watching the overseas CRE exposures. Likewise, we think the risk could be contained on that front, and this is due to their modest exposures with manageable LTV ratios, and they are largely in the less risky senior tranches. So that could help to keep the asset quality pressures pretty modest despite the sluggish real estate markets that we see locally and globally.
Perfect. Thank you. Thank you for that. I guess it sounds like the system is resilient to a certain extent. I guess the question now that we know about risk is, I guess, what about relative value? And perhaps can we look at that from an international investor perspective?
Sure. Now, in terms of relative value, Korean banks' dollar tier twos offer a little spread pickup for moving down their capital structure. And this is because they trade about 1.6x or similar maturity senior debt. And this compares to its global banking peers of AA range rated banks such as Singapore, Aussie, which trades about 1.8x. And this is also way tighter than the historical T2 to senior spread differential of 1.8 to 1.9x. Now, we would actually believe that at such current spreads level, they are pretty tight for the South Korean banks on the tier twos.
Perfect. Good. I guess that makes sense. So, in one hand, it's a more resilient system, but it also makes sense that the relative value is a bit tighter. It's great. That was great, Reina. Thank you so much for coming, and we look forward to having you again.
Thank you.